You go to a shopping mall just for window shopping. Suddenly you find an object that is very attractive and good looking, and you are tempted to make that purchase right at that very moment. Well, you might not even have the cash for it, but you think, okay, I have a credit card. Even though you have exhausted 70% of your credit card limit, you think, well, what's gonna happen? Let me just exhaust 100% of it. So you end up buying an object with your credit card limit, even though you might not need it. So these kind of frivolous purchases actually have a negative impact on your credit score. Well, you ask, why do I even care about my credit score? What's gonna happen? Just think about it. You and your lovely family were living in a rented house for 10 years. You thought that it's the right time now that we buy our own house. You always had a dream of buying a house in a gated society where it was equipped with all the modern amenities. You and your family decided to visit a society that was being built, and you even finalized the house. You thought that you would go to the bank and take a home loan for it, and you can just pay easy EMIs and own the home. Well, when everything was done, you went out to the bank to apply for a loan. But suddenly the bank manager comes in and says, I'm really sorry sir, you have a low credit score. We can't give you a loan. And all your dreams shattered with that one sentence. Just so that this situation does not happen with you, we will be talking about what credit score is, what is its importance, and how you can improve your credit score. Hi friends, my name is Harsh Srivastav. I'm an ex-investment banker, a business owner, and a finance content creator. On this channel, I talk about topics such as real estate, cryptocurrencies, stock market, budgeting, investing, insurance, and much more. So if you are new here, do hit that subscribe button and click on the bell icon so you don't miss out on any of my future videos. So let's get started with the video. Having a low credit score can get you denied from getting a home loan, a car loan, an education loan, or for that matters, even a credit card facility from the bank. So now that you understand the importance of a good credit score, let's drill down on how banks decide whether to disburse a loan to an individual or not. So there are various credit bureaus in India such as Experian, Griff Highmark, Equifax, and the most popular one, TransUnion CIBIL. The banks and all the other financial institutions share the credit activity done by all individuals to credit bureaus such as CIBIL. And CIBIL then utilizes this information to create a centralized database and issue a credit report for all the individuals. CIBIL stands for Credit Information Bureau India Limited. It is a private company that is licensed by RBI to collect the credit information of all individuals in India. It was incorporated in the year 2000 but was later on acquired by an American credit reporting agency, TransUnion. It had acquired 92.1% stake in the company to make it TransUnion CIBIL. The credit report issued by the credit bureaus in India has a lot of critical data points attached to it. However, we are going to focus on the three most critical data points that the banks use in order to finalize whether to disburse a loan or not. So the first critical data point is the 3-digit numeric credit score of the individual. The 3-digit numeric credit score can range from 300 to 900, with 300 being the worst and 900 being the best. A good credit score would be anything above 750. High credit scores allows you to avail benefits such as faster loan approvals and the lowest interest rates offered by the banks on various loans. If you have never taken credit or there is little information on your credit activity, then there is a possibility that your credit score is not available. In that case, you can decide to reroute some of your already existing expenses through a credit card in order to start building your credit score. The second critical data point is the credit history of the individual with all the lending institutions. The credit history in your credit report reports all the previous loans that you have taken and how responsible you were in meeting those loan obligations. Lastly, the third critical data point is all the credit inquiries the individual has made in the past. Whenever you ask a bank or a financial institutions to disperse a fresh loan, these banks and financial institutions go out to the credit bureaus in order to raise a request for your credit report information. and this counts as a credit inquiry in your credit report. All these three parameters allows the banks to know what is the potential risk in lending money to an individual. So the next time you apply for a car loan, a home loan, a personal loan or an education loan, the banks will look into your credit score in order to decide whether to sanction your loan or not. So now the question is, how can you maintain a good credit score? And if you do not have one, how can you start building it? So let me share with you some good practices that you can adopt in order to maintain a good credit score. Your past repayment history is given the highest weightage in the calculation of your credit score. So it is really important that you pay all your dues on time. Also, it is advisable that you review your credit score a few times a year. This will allow you to dispute against any rare discrepancies in your credit report, such as a rejected bank loan application. You can log a dispute on CIBIL's website, or you can also simply ask your lending institution to send the correction to CIBIL so that your CIBIL score can be reinstated. Lending institutions have a limit on the maximum amount you can borrow under a particular line of credit. Say for example, you use a credit card and the limit on the credit card is 1 lakh rupees. It is recommended that you utilize below 30% of your available credit card limit. So in this case, using your credit card for an amount of up to rupees 30,000 would be a good scenario. If your credit utilization on instruments such as credit card is nearly 80 to 90%, in that case, the credit bureaus feel that you are not able to finance your day-to-day expenses without credit, and this impacts your credit score in a negative way. So in our example, if you are using 90,000 rupees of your available credit card limit, that is a big no-no. It is also crucial that you pay your credit card bills on time, and only if there is a financial crunch, you can go ahead with paying at least the minimum amount of your credit card bill. Coming to the credit mix of an individual, there are two kinds of loans. One that has a collateral attached to it, such as a home loan, and the other which does not have a collateral attached to it, such as a personal loan or a credit card. Loans that have collateral attached to it are called secured loans, and the ones which do not are called unsecured ones. If your credit mix comprises of more of secured loans than unsecured ones, then it helps to increase your credit score. The reason being, credit bureaus feel that you use your credit responsibly. On the other hand, if your credit mix comprises more of unsecured loans, then the credit bureaus feels that you are not using your credit responsibly, and that impacts your credit score in a negative way. Number 4 is the number of hard inquiries you make. When you yourself go to the CIBIL's website and apply for a credit score, it does not count as a hard inquiry. However, when you apply for a loan to the bank or any other financial institution, they raise a request to the credit bureaus for your credit report information. And in that case, it counts as a hard inquiry. So when you apply for too many loan applications in a short period of time, the credit bureaus feel that you are credit hungry and you are not able to live under your means. And this affects your credit score adversely. So it is recommended that you do not apply to too many loan applications in a short span of time. Lastly, if you have stuck till this point of the video, there is a bonus point for you. Many a times, your close family members or your friend may ask you to be a cosigner for a loan or a guarantor. In that case, it is your primary duty to ensure that the loan obligations of your friend or the relative is met on time. If the loan obligations are not met on time, this will impact your credit score in a negative way. So you have to be very cautious when you become a co-signer or a guarantor for a loan. Thank you so much for watching. Hit that subscribe button, click on the bell icon, and stay tuned for my next video.